In this video, we're going to walk through the accounting for debt securities classified as trading. And again, trading securities are securities that we've purchased and are holding primarily for sale in the near term in hopes to generate income on short-term price differences. So in other words, we're buying and selling, hoping to make a profit. From a valuation perspective, we record them at their fair value, and any unrealized gains or losses are reported as part of net income. So again, record them at fair value. Unrealized holding gains and losses are part of net income, and that gain or loss is determined as the difference between the fair value on the balance sheet date and the amortized value of that debt security. And we record that unrealized holding gain or loss separate from any interest income, dividends in the case of stock. Let's walk through a quick problem. In this problem, the Shamrock Company has purchased $100,000 of 6% 5-year semi-annual coupon bonds of the Chester Corporation. So semi-annual, every 6 months. The bonds provide a 5% return, and Shamrock classifies the investments as trading securities and uses the effective interest method to amortize premiums and discounts. First thing we're asked is for the face value, which we're told is $100,000. And we need to calculate the carrying value or the purchase price at the time we bought the bonds. And again, semi-annual. So we're going to take N will be 10. That's the 5 years times 2 because it's every 6 months. We take the 5% market interest rate and divide that by 2. Our coupon payment will be that stated rate of 6% times the $100,000, which would be $6,000 a year, but it's semi-annual, so $3,000. And again, we enter the $100,000 as the future value for our bond, and we solve for the present value. And again, we see this bond is selling at a premium because it has a stated rate of 6%, and investors are only demanding a 5% rate of return. So it looks like a good bond. We'll bid up the price, and we'll bid up the price to $104,376. Again, cash received. Every 6 months, we will receive that $3,000 coupon. And again, that's the 6% times the $100,000 divided by 2. Our interest revenue will be our 5% divided by 2, which is 2.5% times the prior period's carrying value. The difference between the cash received and our interest revenue gets recorded as an amortized premium. And of course, over time, our bond will be going down in value, or we should say its carrying value will be going down. So at the end of the first period, it'll be $103,985. The next coupon date is January 1, 2021, when we will receive $3,000. Our interest revenue will go down because, again, our carrying value is going down, and the amortized premium will go up. We can copy that down through our table. At the time we purchase the bonds, we will debit debt investment for the $104,376. Again, we don't use a premium or discount account for assets, and we credit cash for the $104,376. On the first coupon payment, we will get $3,000 in cash. And again, this is the first row of our amortization table, and we will record a credit to the debt investment for $391 and interest revenue of $2,609. Now on December 31st, 2020, we're not going to receive a coupon payment, but we have interest income. We've earned $2,600 in interest revenue. And again, we're picking that up off the 1/1/2021 row from our amortization table. We're not going to get the cash, but we can record interest receivable of $3,000. And then, of course, when we get the cash on January 1, we record the cash and clear out the interest receivable. And to balance our entry out, we credit debt investment, further decreasing it by $400. So again, even though we're using a fair value method, we record interest revenue and amortize any premiums or discounts according to our effective interest method. Let's go ahead now and take a look at a fair value adjustment. We're told to assume the balance in our fair value adjustment account is 0 at 12/31/2020, and the bonds have a fair value of $104,000. Prepare the journal entry for the fair value adjustment. So our bonds are being carried on our books right now at 103,585. So the difference between our $104,000 and our carrying value of $103,585, we need to increase the fair value of our bonds, and we will record a $415,000 unrealized holding gain, and that's part of net income.